This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Looking Under the Hood of Markets, the title of this week's Postgame chart book. You'll find the download link in your Research Roundup email. If you're not a registered user yet and don't have a Research Roundup email, just go to our homepage, macrovoices.com, click the red button that says Looking for the Downloads above Luke Groman's picture. Patrick, let's look under the hood of this market. Page 2, S&P 500 futures. Boy, sure looks like the relentless climb is continuing.
The climb is definitely continuing, and some of these different measured moves that we do are targeting levels toward 3,900 and 4,000. So, I mean, the market edging higher is definitely on the table. The interesting part is that we're going into a major option expiration. Usually, we've had Charlie McElligott on the show before talking about the gamma pins and some of the variables that come in. So it's entirely possible we're going to be closing somewhere around this 3,800 level going into there, but it'll be really interesting to see whether or not the volatility returns next week. And what we find is a very interesting circumstance where even though the rally has been very methodical and just slow in its grind, I want to talk about some other charts that just tell a little bit of a different storyline. But what is interesting on this particular page is how bullish the sentiment has gotten. We're now seeing a situation using everything from the breadth of the market to momentum and put call ratios. We've now reached a point of sentiment to the 98th percentile going back to 2004. This is from Nomura Research. And really, we just have a market that is incredibly bullish from sentiment perspective. A lot of people ask me, well, why does the top have to even be considered here? Because the market hasn't really started to melt up yet. We haven't seen this S&P really accelerate to the upside. So why is there risks in the market? So I wanted to put a little bit of context on that. And on page 3, what I wanted to do is look at the performance of different parts of the market in this kind of post-market crash period. So everything starting in that March-April period. And the black line at the very bottom is the S&P 500 performance. And what you can really see is that the majority of the performance has come in a lot of the secondary kind of areas. Like, for instance, semiconductors are up at this stage, 117% off of their lows. But then you take something like the copper producers up almost 200%. Then I decided to put ARK Investments, Kathy Wood's ETF out there up, 260%. And of course, the TAN index, which is the solar ETF, up almost 400% off of those lows. So there's all sorts of these sectors that are doing these much accelerated parabolic rises in a span of less than a year. And what it reminds me a lot of, and I wanted to kind of go through the thought exercise of on page 4, looking at what happened back in the 1998 to 2000 period. And what we have here in the black and yellow line is the Russell and the S&P 500 performance, which were doing pretty good and all right on their rise. And in fact, were not impressively strong in the final 6 months of the rally, but it was the NASDAQ that went parabolic up 300% in that big bubble blow off. And so even though we're seeing all these bubble kind of price action in some of these different markets, but it doesn't have to necessarily mean that the S&P has to rally in order for some sort of a market top and mean reversion to begin on many of these moves.
Yeah, this chart really speaks to me in terms of how much farther the craziness in Bitcoin could continue. And I do think it's a speculative mania. I don't think there's any fundamental justification for this big rally that we've seen in Bitcoin. But if you look at what happened in the late 90s, you had what were frankly some pretty darn simple concepts that for some reason Wall Street guys just couldn't get straight. The web is going to be a big deal, and that means that websites that actually make money are going to be really, really valuable. Somehow that got translated to anything that has .com in its name is selling at, a zillion times earnings, or it doesn't have to have earnings, or it has no plan to ever have earnings, or what have you. And it was just crazy. And eventually they sorted it out and they figured out that, the web is going to be a big deal, but that doesn't mean that people who have no business plan and are just putting, companies together based on nothing should be rewarded. And it took a long time for them to figure that out. And the thing is, it was pretty simple. Now, if you take what's going on with digital currency, which is going to completely change the world, and you really try to get your head around it and understand why there is a big difference between saying that digital currency is the way of the future, which I'm convinced that it is, versus saying Bitcoin is going to be the predominant digital currency, which is what the so-called Bitcoin maximalists think. That's a much bigger piece of technology to get your head around and understand than what we were wrestling with in the late 90s by at least a full order of magnitude. And, if it took us a few years in the late 90s to figure out that these valuations were nutso before it finally, had a blow off top, it says to me that the crypto craze probably could run for quite a while longer. Most people don't understand it at all. And I think there's lots of room there. In any event, I know crypto is not where you were headed with this, but I'm curious to get your perspective on that, Patrick.
Well, I just wanted to add to that because I think that while crypto is certainly got all the characteristics of that bubble parabolic rise, there's no shortage of sectors within the markets, and especially in the EV space and the solar stocks, and there's a whole series of different sectors within the market that are seeing the same parabolic moves. It's just the typical froth that's associated in the easy money environment that comes in these kind of bubble phases. And one of the things, though, that I wanted to kind of think through and really debate, on page 5, what I was showing was the bear market that followed. And what I really want to capture, not this as an analog of what I believe is imminently going to happen to the stock markets, but rather the sector that performed the best on the way up was the one that underperformed the worst on the way down, or had the most room to fall. And while because of all the inflation expectations, there's a lot of people arguing that this time around we're not going to have a bear market the way we did, let's say, back in 2000 to 2002, because stocks are an inflation hedge and inflation is coming, and therefore the stock market will do well. But I kind of look at this chart and see that the NASDAQ dropped 80% off of its highs, while the Russell and S&P corrected a much more modest 30 some odd percent. And what I'm thinking in this time around, what if we don't have a bear market on the primary stocks, and stocks do what many people anticipate as be an inflation hedge, but that doesn't mean that these bubbles sectors in the market won't have a very deep mean reversion. This overshoot that's happening in this space can still have many of those stocks in those sectors wipe out 50% on the downside, and us still on the broader equity indices see the market doing just fine. It's a really interesting moment in the markets where these parabolic rises can't last forever. Otherwise, these companies will all within months be multi-trillion-dollar companies. And so really what it comes down to is what will it look like in a period where they finally exhaust themselves to the upside and mean revert. And that's probably one of the more interesting things we're probably going to see in 2021. And trying to solve the puzzle piece as to when it begins is going to be really interesting.
Patrick, let's move on to page 6. Boy, you can see the 200-day really looks like that's what's filling in and holding the gold market up. Do you think it breaks and we test that lower support zone, or do you think that this is going to hold?
Well, it's interesting because Luke Groman was just talking about the idea of 5% or so on the downside potentially of gold. And it's interesting that that's a level that lines up with the consolidation from April to June, where there's some high volume nodes that create that consolidation. And if we broke the 200-day moving average, that's that 5% downside probably that Luke was referencing to. And I think that's the single biggest thing to watch here is that was this simply just a short-term correction that comes to the support line, like back in during the March crash, and once again in the sell-off in November. Each time the area or zone around the 200-day moving average did mark the low of for a swing low of gold, and then gold turned and rallied from there. And watching whether this time around acts as a support is also one of these really important moments, because either this is an extraordinary buy on dip, or there's going to be a lot of technicians that are going to have the red flag waving as 200-day moving average is broken, which for many traders is a sign that the bull market may have exhausted itself, and maybe spur on some liquidity selling in the gold. I personally remain optimistic on gold, but it's a very critical moment technically.
Well, and I think the thing that would get you that breakdown below the 200-day would be if we continue to see real yields, at least in the immediate term, continuing to trend higher. That's gold's biggest enemy. And it's amazing to me that people can't see the forest for the trees and recognize that it's not likely to end very long. But frankly, it's fine with me if we get a big dip down to, looks like this support zone bottoms out around 1680 or so. Maybe we go even deeper than that on a break below the 200-day. There's a chance to buy more gold as far as I'm concerned, because I know at the end of the day, or the end of the decade, as the case may be, I've got Janet Yellen and Jay Powell on Team Fed and Treasury in order to make sure that the government prints enough money to debase the dollar and make that gold worth more. So I'm just not worried about it long term. But I could easily see if we did have this continued trend of real yields trending higher, that it could take gold lower. In any event, Patrick, let's move on to broader commodity indices on page 7.
Really, what I was just trying to capture here is just that this impulse higher in oil is not the only commodity that's hot. And I'm sure many traders and listeners have already been tracking it, but it's a very broad commodity rally at this stage. I have here corn and soybean and copper and iron ore, but there's no shortage of these commodities that are all up and have more or less been in a pretty decisive uptrend, particularly many just beginning to accelerate in November on the upside. And this has been a very hot sector. There's a whole array of these commodity stocks that are just doing extraordinarily well, and then just continuing to feed more and more sectors that are doing these almost parabolic rises on the upside. And this is obviously feeding the reflation trade, weak dollar, rising commodities, and kind of creating that feedback loop. And it's really going to be interesting to see how long these trends can still continue through January.
Moving on to page 8, let's take a look at the 10-year Treasury yield. Boy, Patrick, we're talking about 10-year yields over 1% as if that were a big number. It's amazing how times have changed. But as I look at what's happening here, it seems like the bottom of that green box that you have would be the logical target for maybe where this goes before it reverses.
Right. And there's a lot of people asking that question as to, how high can yields go before the stock market starts to care? And, where is it that we start seeing yield curve control messaging coming from the Fed? And what I kind of look at is like, really, almost all of the markets have started to return back to their post-coronavirus levels. And it's like, is it really out of line for Treasury yields to come back to 1.5%, a level they were trading at just a year ago? Is that really a crisis? I still think there's plenty of room for bond yields to go without it actually causing a lot of havoc in the markets. But the one interesting thing, and I think it's the one way to perceive it, is that I think that as so long as yields are slowly crawling higher, the market won't react to it. But I think that if we continue to see very rapid jumps in yields and the rate of change of the yield starts to accelerate, I think that that would be what would make the market nervous. And so I think it's just the way it does this rise that will be far more important than the actual level. And I think that's going to be really interesting to see what really was triggered when this 1% was broken out over the last week.
And moving on to page 9, boy, take a look at that 2s10s yield curve. Remember Charlie McElligot's words of fear the steepener. Looks like the steepener's coming straight on at us.
Yeah, and it doesn't seem like anyone's scared of it, is it? But I mean, we did have an inverted curve back in 2019, and really this is now turned up. And we did a long-term chart going all the way back to 1990s just to kind of look at the last few times we've seen the steepeners kicking in, and asking the question, have we seen the beginning of a sustained rise in the steepener? And it really does look like a legitimate roll-up and a potential beginning of a rise. And it'll be really interesting to see, I mean, if with the front of the curve being pinned at this stage, the bear steepener, even if we saw the 10-year yield getting back towards like that 1.5% that we were just talking about, I mean, we could get right back into 2011, 2013 ranges on the steepener. So it's definitely going to be really interesting to see. And it's certainly been the tailwind for a lot of securities that benefit from these wider spreads. And so it's definitely the thing to watch. But what I wanted to really highlight on page 10, though, is those inflation expectations, like your 30-year break-evens on it. And they're really starting to slowly break out on the upside. And I think that this is where we want to really be watching, because if we start seeing that these inflation expectations really start to spike, I think that that's what's going to make a lot of investors and traders nervous about this move.
Well, I mean, just look at it. This huge downtrend in inflation expectations. It bottoms on a crisis where there's a huge stimulus expectation that could easily provide the fundamental impetus for a secular reversal of trend. And so far, the very first step to see if that's going to come true is to get to the short-term previous peak, which was, back at the beginning of 2020. We're already above that one. We're just barely flirting with the 2019 high right now. And if we break above that, the next test is the 2018 high. And if we get above that, boy, it's hard to say that we don't have a secular trend reversal in terms of inflation expectations. And of course, inflation expectations drive inflation. Let's move on to junk bonds on page 11. What's going on here, Patrick?
I find it really interesting that junk bonds haven't got the memo that the rest of the bond market is selling. And obviously, junk bonds tend to have a strong correlation with equities, just the nature of what we've seen in the past. But what we continue to see is that Treasury bonds are selling, which is the blue line over there. And even we started to see the investment grade corporates start to get very heavy and roll over. But the junk bond market continues to be very quiet and holding up along its highs. And I think one of the more interesting things, like when we look at the corporate bond options adjusted credit spreads on page 12, you can see that we continue to hover both on investment grade and high yield very close to, the decade lows or multi-year lows, definitely. And the question is that at what point do these corporate bonds start to price in some sort of risk? And, there's potentially with the continuation of this coronavirus, there has to be some potential risk of increased defaults on some of these periphery companies. And clearly, this credit spread is not pricing in much worry at all. It's going to be really interesting to see when we see the junk bond market start to turn a little bit. It certainly is not showing any sign of that now.
No, it sure isn't, and it's tempting to say, okay, there's a trade there. But boy, how many times in the last few years have we looked at junk bonds and scratched our head and just said, boy, they're not pricing in the risk, but that didn't change. You don't really want to bet against it until you can see it actually start to move. Moving on to page 13, of course, you can get a free trial to Big Picture Trading and get Patrick's chart books not just once a week, but almost every single day, 4 days a week. Information is there on page 13.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.